Hello darlings, I'm Matt.
And I'm Megan.
And welcome to College Uncomplicated's Financial Aid Boot Camp.
So today we're going to be talking about loans, but first let's define loan. A loan is money that is basically given to you that you have to pay back with interest. Loans can be state, federal, or private-based. Today we're going to be focusing on federal-based loans.
There are three major types of federal student loans. The first major type of federal loan is the Stafford Direct Subsidized Loan. Stafford Direct Subsidized Loans are one of the best types of federal loans, primarily because the federal government pays the interest while you are still in college. So the student won't have to worry about it upon graduation. So the subsidized loans are need-based, so they're given to students who demonstrate that they need money for college. The maximum amount for first-year dependent students is $3,500. However, the amount can increase for second, third, and fourth-year students.
The second major type is the Stafford Direct Unsubsidized Loan. That means that the government will not cover the interest on this loan, and the amount that you take out depends on student need and the maximum allowable amount.
Now, when Megan says the maximum allowable amount, what she's referring to is the maximum amount of Stafford loans that a student can take out. This includes both the Stafford Direct Subsidized and the Unsubsidized loan. For instance, for a first-year dependent student, the maximum amount of Stafford loans a student can take out is $5,500. Now, if we were to calculate that based on a student who got $3,500 in direct subsidized loans, they could only take out an additional 2,000 unsubsidized loans for their first year of college. Just like the loans themselves, the borrowing limit will increase every year a student is in college up until the student's fourth year.
Both types of Stafford Direct loans have a 6-month grace period. That means if you graduate or leave school for more than 6 months, that's when you start repaying your loans. If you re-enroll or go to grad school, then you no longer have to pay on those loans until you graduate or leave for another 6 months.
So something that has been given a lot of attention lately is the student interest rate for these very loans. Currently, the interest rate is 6.8%. However, loans taken out prior to July of 2013 have an interest rate of 3.9%. In late 2012 and early 2013, when Congress and the President were unable to reach a bipartisan education deal, the interest rate doubled from 3.9 to 6.8%.
As a result, any Stafford Direct loans that were taken out after July 2013 will have an interest rate of 6.8%.
The third type of federal loan is probably the most elusive, and that's the Perkins loan. The Perkins loan is only available at schools that participate in the federal Perkins loan program.
It is a subsidized loan, meaning that the government will pay the interest on the loan, but it's at 5% rather than 6.8% like Stafford Direct loans. It also has a 9-month grace period rather than a 6-month grace period.
The other major difference is that instead of taking the loan out through the federal government, the loan is actually taken out through the institution,
meaning that you'll be paying it back to the university rather than the government.
Now, when it comes to getting loans, the process is the exact same for all types of financial aid. You just fill out FAFSA, go through verification if you need to, and eventually you'll get a financial aid package. Typically, the federal loans will be part of that very financial aid package. In order for the loans to be dispersed to your account, there's a couple extra steps that you need to take. The first part is you need to sign the Master Promissory Note, or the MPN. This is basically the document that you sign that says you know what you're doing when you're taking out this loan, and that you understand that you have to repay it after you graduate or leave school for longer than the grace period. Part of signing the MPN, you're going to be going through something called loan counseling, where basically you will answer a bunch of questions about interest rates, repayment schedules, and different options that are available to you after you graduate. This will prove that you know what you're doing when you're taking out the loan, and the federal government can give it to you in good conscience.
So we just told you about the 3 types of federal loans: Stafford Direct Subsidized, Stafford Direct Unsubsidized, and Perkins loans. There are state loans available, but they are rarer than federal loans. Another type of loan is a private loan, which is given by a bank or another money lender. These typically come with higher interest rates because banks are trying to make money. So you need to make sure that you shop around for the best loan deal. Major questions you need to ask are: what's the interest rate, the repayment options, and what happens if you default on the loan? This is done to protect yourself, your family, and the all-important credit score. for.
We know this is a lot of information, but remember, this is only one type of student aid that is available. In another video coming, we're going to be talking about scholarships and grants.
Check back next week for that very video.
And if you liked this video, be sure to like it, as well as subscribe to College Uncomplicated.
You can also like us on Facebook or follow us on Twitter or Pinterest at College Uncom.
And leave any questions that you have in the comment section below.
Until then, I'm Megan.
And I'm Matt.
And we'll see you next week.